Hello, and welcome to our Fed Talk. I'm Matt Deines, President and CEO of First Fed Bank. Today, we are going to talk about refinancing your home mortgage loan. When does it make sense to refinance, and when doesn't it? The key data points to evaluate are your current mortgage interest rate and the date that you opened your mortgage loan. A good guideline: if your interest rate is 0.5% higher than today's rate, you could save money by paying less interest and potentially lowering your monthly payments by refinancing. For example, if today's rate is 3% and your current interest rate is 3.5% or higher, you may want to consider refinancing. The date you opened your current loan is important because the more recent your purchase or last refi, the more money you will save by lowering your interest rate today. If you just bought your home recently, that may seem like a lot of work to go through. Why would you redo all of the mortgage paperwork again? But the real question is, do you want to lower your interest costs and your monthly payments? The sooner you refinance, the more you will save over the life of the loan. A lower interest rate means lower payments. More money in your pocket over many years can add up to major savings. Another guideline: do you have less than 1/3 left on your current loan term? For example, do you have less than 10 years left on a 30-year mortgage or less than 5 years left on a 15-year mortgage? If so, it may be a good idea to keep your mortgage even though today's interest rates are lower. That's because in the final years of an amortizing loan, more of your monthly payment goes down to paying principal than to interest. There is an exception to this term guideline, and the question is, do you need the money? Who doesn't? I'm talking about big money for a major expense like a home remodel, college tuition, or perhaps even a vacation home or the purchase of an investment property. A cash-out refinance can be a good solution for these major expenses and investments. That's because the interest rates on a cash-out refi on your primary residence may be much lower than the interest rates for investment properties, home equity loans, and in particular, credit cards. To recap, these are the points to consider. Are today's rates at least 0.5% lower than your current rate? That can be enough to cover any fees and for you to gain significant savings. Are you less than 2/3 of the way through your current loan term? More time left on your loan means more time to save with a lower rate. Do you have any major expenses or investments planned today or in the near future? If so, a cash-out refinance can be a great option to cover those. If you have any questions, check us out at ourfirstfed.com or reach out to contact one of our amazing mortgage experts. Thanks for tuning in to our Fed Talk today.